Russia has defaulted on its foreign debt for the first time since the 1917 revolution, according to reports. The country missed a deadline of Sunday night to meet a 30-day grace period of interest payments on $100 million and two Eurobonds originally due on May 27. Some Taiwanese holders of Russian Eurobonds said on Monday that they had not received interest payments due. That's after Russia's attempts to pay it in rubles currency were blocked by international sanctions. Russia has called any default artificial, as the Kremlin claims it would have ample cash to pay its debt, but says sanctions have frozen its foreign currency reserves held abroad. For more on this, now let's go to David Madden, who is Equiti Capital market analyst in London. David, many thanks for being with us today. As I understand, a formal default in Russia would be largely symbolic, given that the country cannot borrow internationally. But I guess the stigma of the default would potentially really raise its borrowing cost in the future. What would the implications be then of this default?
Well, as you mentioned, they're essentially locked out of the international monetary system. They have been for several months now. So it's almost as if the financial markets were pricing this in several months ago after the announcement was made by the likes of the SWIFT payment program. They're essentially locked out, and essentially how for the vast majority of countries around the world, rubles are basically not accepted. And also, not to mention, dealing with Russia in any kind of form is not particularly popular at the moment. So the financial markets aren't really, quite frankly, too fussed about this. But we're seeing strong gains here in European stocks. US index futures are pointing higher. So equity markets and the financial markets as a whole are not really too concerned about this. You mentioned about the long-term implications of this. It's certainly going to impact Russia's credit rating in terms of borrowing costs, but let's face it, in the grand scheme of things, it's not exactly unexpected, given the reputation after the illegal invasion of Ukraine and the horrendous violence we've seen since then. So this all would have been factored in by the markets several months ago, and given Russia the Russian government as many things to reflect on in terms of reputation, not to mention higher borrowing costs down the line. So this will just already prolong the kind of pariah status that Russia has.
Interesting, David. And you say equity markets around the world are not too fussed about this. What about Russia? Is Russia really fussed about this for the time being or for the future? At the same time, we saw G7 nations mulling a price cap on Russian oil to build pressure on the country's economy. Would it really build pressure on the country's economy?
I think given the decisions the Russian government has taken in the last few months, I'd imagine that they were automatically factoring in being kind of put into kind of pariah status and finding themselves in a situation with very few friends and allies. So I figured this was already kind of somewhat factored in even before the invasion took place, or as the events were unfolding. In relation to the price cap, it's more about Western economies trying to say how we're looking at targeting Russia, but they've already done probably the most economic damage they can do to Russia so far. In relation to the price cap, the talked about price cap, it's going to essentially drive buyers of oil into the hands of other vendors of oil. So although it might look to actually kind of put further pressure on Russia, it's not going to be alleviating the relatively high levels of oil that we're seeing. So the only thing that's really going to alleviate the high levels of oil that we're seeing is actually if members of the kind of Middle Eastern OPEC countries were to seriously ramp up production, and given that they haven't really been hitting their own self-imposed targets of raised production in the last few months, they don't really seem to be in any great hurry to do that either. So I think regardless of what goes on with the G7 and the oil price cap, I suspect we're going to see oil north of $100 for several weeks and months to come.
David Madden, many thanks for this interesting update.